Right, Claire, it's 3 or 4.
Okay, let's get started because I did want to do a little bit of thing about STEP before we started as well. Welcome everybody to ERA Live. Thanks for joining us today. It's good to see you all. Hope everyone's staying cool in this summer heat. Today we have a little bit of a longer session than usual because we have two presenters. The first is Dennis Reed, Senior Analyst at Edgewater Research, who will give us a mid-year market and economic update, along with reporting some of the latest ERA survey trends that our members have reported recently. And then Mike Budde Jr. is going to join us to talk a little bit about his company's recent acquisition by Orbweaver and what that means for us. But before we begin, I want to talk to you all for 30 seconds about STEP. I'm going to share my screen really quickly. Okay, so I just want to remind everyone that STEP registration is now open. If you're not familiar, STEP stands for Sales Training for Electronics Professionals, and it is a virtual but live sales training program that we host every fall. This year, it's taking place September 29th through October 1st. There are 3 sessions per day that you can take in the comfort of your home or your office. If you happen to miss a session, all attendees receive lifetime access to all of the session recordings. And I do want to emphasize that our training is for newcomers and veterans alike. It's for everybody, no matter how long you've been in the industry. And our goal is to just help you sharpen your sales skills and stay up to date on best practices for sales and this industry. So we hope you'll join us or forward this information to someone who you think would want to join us. And just an incentive, if your company is an ERA member, you receive a $100 discount on your registration fee. So with that, you can either use this QR code on this slide for registration info, or you can just send me a message in the chat and I will put a link in the chat as well. So that's it. Thank you for letting me talk about STEP for a minute and let's get started. So everyone just remember to please put yourselves on mute. Um, if you'd like to ask a question, please type them in the chat box and we will get to your questions. This session is being recorded. We will post the recording on our website and our YouTube channel within 24 hours. So let's start with our presenters. First up is Dennis Reed. Dennis, the floor is yours and please take it away.
Thank you very much, Claire. Thank you, everybody from the ERA. It's always a pleasure to provide an update, and I think very, very timely with, I would say, what has been nothing short but a crazy year this year, and in many cases, a continuation of trend, but probably a more appropriate way, an acceleration of trend, which is also manifesting itself in some turbulent times across multiple points of the supply chain. So, hope to cover all of that. Very similar to Austin back in February, which feels like a lifetime ago. Agenda for the day, we'll talk just about the survey and the reminders and the mechanics. I can't emphasize this enough. Ultimately, a lot of this data is your data as the membership. The more one, it is very, very accurate, but two, the more people participate, the more accurate it becomes. This is only for your use. So please, 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 if you're not participating, reach out to me. I'll have my contact info. We'll make sure that your organization is plugged in to participate. Then we'll talk about an intro to who we are, what we do. We'll talk about the year-to-date sales. We'll talk about our end market outlook, a little bit about the supply side, and we'll wrap up with kind of what this means for the year. So from a quick mechanics, just to remind everybody, the survey is conducted monthly. Roughly the first of the month, you'll get an email from that awful email, no reply at mail, et cetera, et cetera. It's not spam, it's not phishing. As I will show you on the next slide, it is branded both ERA and Edgewater. There will be 2 additional reminders sent via the system. The results are roughly captured by the 15th of the month. We have them over to Claire, roughly call it the 15th to 17th, and they are published behind the paywall for your use and your use only. This is just what it looks like. So again, if you see this, this is not spam. This is not phishing. This is real. So with the mechanics behind us, a little bit for those who don't know who are we at Edgewater? We're an independent research company based here in smoky and steamy Cleveland, Ohio. We focus across the internet, consumer, e-commerce, and technology space. And I should actually update this. As of late last week, we now have an industrial coverage that is focusing on markets like fluid power, electrical equipment. So some of the customers that the ERA members, and really when you think of that AI data center plus one, really focused on that. We service many of the largest money managers in the world who invest in our case in technology customer companies. Then we provide critical business insights then through our fundamental research process. And our reputation dates back over 2 decades. It's late in the day, so you might actually be able to see the gray hair. And as my daughter pointed out this weekend, my hair looks terrible because I spend too much time going to lacrosse games, not enough time in the office to actually get a haircut. But long way of saying we've been at this for a long time. Our technology team, just focusing on the component levels, is probably north of 70 or 80 years of experience. So long way of saying we've seen a few things over our time following the industry. And then why do our customers work with us? As I mentioned, that fundamental process, we're deeply committed. We're deeply connected and committed to the industry. On the hard technology side or the component side, I like to say from sand to silicon, to distribution, EMS, OEMs, really across the whole supply chain, trying to identify inflection points when the business change, so you ultimately can make informed decisions to better position your business. As mentioned, we are a resource for the investment community. They also are important to us because certainly they pay for this lovely office space and our salary and everything else, but they also give us a line of sight into where capital is flowing, which is ultimately driving the investments in all the products that you guys are working on. And then we're a critical partner with our industry customers. We work across a number of functional areas, working with them to identify the trends and assist them in shaping their strategy to ultimately capitalize on those opportunities. My contact info, another QR code. My contact info is on here. I will get Claire and the team the slides as well. I know we have a full slate of stuff, so if the questions we don't get to today, please feel free to reach out. Happy to jump on a call, Zoom, Teams. Happy to answer via email if there's any questions that arise, either after today's session or after you see the slide deck in hard copy. So let's start with the ERA sales growth. As you can see, it has been a good year, and I'd call it a good year in terms of a rolling basis. The business ultimately turned roughly last year in April. For those of you that recall the mid-year update at this time last year, it was kind of a question of what does this recovery look like? We saw a sharp rebound in April right around the Liberation Day tariffs. That seems like eons ago. From that point, we kind of settled into a seasonal type pattern from a recovery, which is, I would be the first to admit, kind of atypical. And the business certainly changed really around that October or November period of last year. And really, to summarize it in one sentence, in terms of what changed, ultimately, the tentacles of AI have dropped into the real economy. As we look at the broader market, and you'll see some of the slides with our forecast at the end, if you look overall, including memory, AI processors, things like this was a very short and shallow recovery. For all of us in the business know it was a very long, painful, drawn out one. So the fact that the recovery finally extended beyond just the AI data center and the memory players was widely positive for us. It certainly lent its way to breadth and stability in the recovery. And when I talk about the AI plus one, referencing things like power supplies, referencing items like grid energy infrastructure, HVAC suppliers, even down to some of your heavy equipment in capital equipment like Caterpillars and Deeres or things like that with the big earth moving machines. At the end of the day, all of these data center construction, in particular, when they're talking about adding roughly 1,500 data centers to the US over the next several years, we need to build and plug those into the grid. And that's ultimately what's changed in the demand profile. As that's shaped into this year, it really becomes a story about a cyclical recovery led again by broad-based growth, but also a case of lead times extending, which is further, and we'll talk about this in terms of bookings, but really further led to strength in bookings, continued growth, and then also pricing activity. So where we sit at the midpoint for the year, we're tracking up in the high single digit range. And again, in terms of an accuracy, we would agree 100%. We know the data skews to the Americas. We know this doesn't fully capture the high density memory, which is often done direct with some of the big memory suppliers. We know it doesn't capture the AI processor. Those are the ones that are putting up, to use a technical term, very insane growth rates this year. As we break down what's contributing to the growth, and I think, again, this is one of the most important elements for you guys to look at, it's really across the board. So here we're showing average sales growth year over year by month. We're showing the price contribution that all the members are estimating. And then from that, we're also able to back into an implied volume growth. And while pricing is certainly up this year, led most notably by memory, as everyone knows, followed by the IP&E market, with several suppliers coming to market with 2 to 3 to even some cases 5 pricing moves this year. The most important thing when you think of the broader electronic component space, this is a volume-led recovery. It's not all price, which again, when we think about sustainability, and by sustainability, I mean through the balance of this year and into next year, the fact that it's volumes and not only price gives us a certain level of comfort that the demand is real. And ultimately, we'll get into some of those end market drivers as we get into the end market section. Along with that, you can see the bookings growth. And again, bookings here have been positive for 20 plus months. And albeit, again, when you go back to the early months of the bookings recovery, we're talking very, very low single digits. And I would ascribe most of that to it would have been a really long, painful downturn. But again, as we've gotten into this year, you've seen bookings grow into the double-digit range. What's behind that? As I touched on the previous slide, certainly we're seeing a rebound in volumes, which is definitely a good news story. We're seeing, we are in an inflationary environment that's obviously adding to the bookings number. But again, I think it's worth noting about the cyclical side, lead times across the boards, and we'll talk about that in a couple of sides. Lead times across the boards have moved out. As everyone knows, when lead times go out, bookings go up. So it's not uncommon across the industry to hear very qualitative statements that book-to-bills are approaching 1.3 or 1.4. And on the next slide here, I'll show you what our members are showing from a book-to-bill range. So, we're showing, as of, again, the May period, we're showing a book-to-bill roughly in that 1.5 range. I would tell you, for those who see our reports on a monthly basis, admittedly, that is a bit lighter relative to what we see on the broader market. One thing that I would subscribe to that is, it's really being driven again, and it's not all things equal to all products, but when you look across various commodity types, memory's off the charts. That's sold out effectively for next year. You're talking about lead times that are pushing into 2028 at this stage. Book-to-bills there, if you can call it that, are nothing short of insane. But what's dragging up the broader bookings in our broader reports is really around the power semi space. So you do see pockets of power semis. Those are heavily skewed to the AI space. So again, we're thinking MOSFETs and things like that. We're seeing pockets of those where booking or book-to-bill ratios are approaching 2.0. So again, very, very healthy booking environment. While this does read a little bit, quote unquote, softer, I would focus on the fact that the book-to-bill ratio has really been positive consistently throughout 2025, 2026. So again, when you think of volume-led recovery, a long, stable trend of bookings improvement. And again, bookings really, book-to-bill ratios at or effectively above the highest level in our survey that's dating back almost 3 years at this stage. That's setting up again for a long, long runway for growth. So all in all, to conclude with the data from the ERA survey, very, very positive operating environment. We'll touch a bit on the outlook going forward, but very positive operating environment. Volumes are good. We're in a recovery. I would tell you the single biggest thing right now, and the single biggest risk in particular for the ERA membership is availability, right? So if you're a supplier and you're looking at 2026 from a revenue growth standpoint, your governor on growth for this year is how much you could raise production or utilization rates and how much you take price. If you're in the distribution side of the business, ultimately you're looking at how fast you could move product in one end of the door and out the other door. So again, availability from a component standpoint does seem to be the remaining risk for those that were at our session back in February. I had told you about a whole optimistic outlook for the year, with the biggest risk being demand destruction. We'll start to touch on end markets. Not to put the cart before the horse, we've already seen it. We've seen demand destruction in several markets that we'll address here, but at the end of the day, it hasn't mattered, because that key market being the data center and AI, and then the ancillary industries, again, HVAC, power, grid, infrastructure, et cetera, have all been pulled forward. So again, while we've seen demand destruction, at the end of the day, it hasn't mattered this year, which again was something I would say probably wasn't on my bingo card when I delivered this type of presentation back in February to the membership. As we move into the end market outlook, first we'll start with how you guys see the end market and a quick kind of synopsis of a heat map across really all the end markets that we cover, from aerospace down to smartphones. And at the end of the day, what I would tell you is, with the exception of automotive and consumer electronics, and I'd be the first to tell you the CE space, I think it's worth discounting a bit because it's obviously not a huge presence here. We're in an overall broad level recovery. Again, the markets that stick out as weak is auto, and I'll touch on that in a few slides. PCs, I'll touch on that in a few slides. And then again, on the consumer electronics space, I think that's predominantly an Asian market. Certainly there's new products, there's memory, et cetera, that's impacting that. But again, when you look to the more industrial or the aerospace and defense, we're in a pretty broad-based recovery right now. So how do we see the market? As I touched on a couple of slides ago, the biggest risk that I painted back in February was the risk for potential demand destruction. And since then, we've actually seen it in the PC market. So for those of you that recall, PCs at the time, we had said could be potentially up 5% or so, which puts you in that 285 million unit range. Since then, forecasts has significantly come down, and forecasts are significantly come down due to the memory crisis and shortage, and that ultimately nets us to roughly a 30 or so million units, sorry, not dollars, shortfall in PC units. So, we have units roughly down 10% this year. And again, as I mentioned earlier, while that's certainly problematic, what we've seen in other markets, in particular in the data center, and what we've seen across the board, it's ultimately dwarfed the demand destruction caused by the memory crisis. So, a little bit of a mixed bag here, no change, I would say quarter over quarter, as I referenced on the slide, from when we updated our forecast last. This forecast is new, but no need to change it, as we still think down 10 is the right number for the year. Looking at the flip side of that equation, here is the outlook for the server industry, and that conversely has gone up for a couple of reasons. So previously, when February, we had talked about the server market, where I think I painted the picture that unconstrained demand was 20% plus, meaning you could get all the CPUs, GPUs you were hoping for. Memory wasn't an issue. There were no shortages of memory, et cetera, et cetera, et cetera. From that point, server units have gone from that unconstrained demand was 20. Realistic best case scenario is probably in that 10 to 15% range. We were sitting in the 5 to 6% range. What's changed since then? The server OEMs have basically de-spec'd units. So there has been a move in the server space from using the leading density DRAM in particular to going to smaller density. CPU availability has also improved across the board, which again, in this environment, we're in somewhat of a super cycle. From a data center spend, units matter more than the amount of DRAM per box. So, the hyperscalers in particular have prioritized unit growth. They have had some goodness again from a processor standpoint, which has certainly helped. But again, shifting and downshifting to some of the lower density memories or de-speccing, if you will, has ultimately driven better unit growth, and ultimately that's carrying the bulk of the compute market space that we sit in right now. In past sessions, I've talked about the breakdown between AI, I've talked and cloud, and then the enterprise on-prem. Not much honestly to talk about there in terms of changing trend. On-prem still remains challenged on a relative basis. It's still allocated relative to the AI and data center. But at the end of the day, the core cloud customer, the core cloud hyperscalers, so think your AWSs, your Googles, your Metas, companies like that, their outlook remains robust. Their CapEx profiles remain robust, and that's ultimately driving the unit growth here in 2026. Switching from compute into the smartphone, again, unchanged quarter over quarter in terms of our unit growth, but again, relative to where we were back in Austin, we've seen roughly, call it 100 million units of end demand come out of the TAM this year. So certainly that's problematic, but what I would tell you here in the near term is A, it hasn't mattered, and B, it's been predominantly in low end and emerging market smartphones. So again, while we've seen a significant demand downshift, looking even into next year, telling you that the outlook is roughly a billion units. So I think the supply chain in general, in light of the memory crisis, in light of, again, what's being seen with potential ASP pass through and the question marks around that with the end consumer, we're looking at resetting this bar from roughly a 1.2 billion plus or minus market to a billion units. So certainly still a lot of units, but again, not necessarily the contributor to the overall market, and ultimately not as big of a risk, even if we see another potential downshift into next year from the smartphone space. Moving into some markets that are more relevant to those on the call, we'll start with automotive. So again, looking at the automotive industry, this year we have global production forecasted down, call it 3-4% this year. I think that's a good number. We've actually, I'd say the overall forecast that we heard from the supply chain is flat to down. I think at this end we'd take the down more than the flattish number. Some commentary behind that when you think of the mix. So, what's changed last year? First and foremost, I think most notable, the EV market space in China has certainly slowed. When you run through the EVs throughout the Americas and the West, definitely a slower growth curve there. So, you do have certain mixed pressures across the board with EVs slowing at the margin. Again, we're gone are the years of 40, 50+% growth. So again, EVs are slower, but still growing. Hybrids continue to grow as a mix. And then you have a relatively benign internal combustion engine outlook, in particular across the West. What I will say, and it's a question I've gotten a bunch over the last, call it, couple of months. What impact have you seen from the conflict in the Middle East, the closure of the Strait, et cetera, on fuel prices? What has that done in terms of EV or potential mix shifts? And in all honesty, it's been pretty minimal so far. There's been a slight uptick in the European Union, in the European market relative to previous expectations, really ultimately no change here in the US. But again, I think the feedback in Europe, it's been one, relationship or related to, again, fuel costs, but two, there also have been a couple of new market introductions, most notably from BMW, that have seen some level of consumer interest. But again, the EV market's still certainly slower at the margin. When we look at end demand here again, I would say the overall forecast remains kind of flattish, plus or minus. And again, where we've trended this date has really hovered in that on a monthly basis. We're hovering right around that flattish plus or minus ratio for the year. Moving forward from here, more importantly, I think the bias on that flat plus or minus is probably flat to down again where we are. And ultimately, what's behind that? It's just an overall tough consumer environment. We still have interest rates that, by some cases, some economists would say are stubbornly high. Others might say are stubbornly low. So not trying to get into the business of forecasting interest rates. At the end of the day, they're higher than zero, which is where we were for many years. So the price of a car has gone up. So again, I think what you're seeing at the end of the day from the consumer standpoint, they're trying to stretch miles driven on their car. But again, when you look at automotive in general, what does all this mean? Less EV growth, flat to down production, call it flat to down demand here in the US. At the end of the day, it becomes really a content story. And what does that manifest itself in numbers? Again, vis-a-vis all else equal, no shifts in inventory. We think this is your, 4 to maybe 8%, depending on the year, individual suppliers, programs, ramps, etc. But again, we're in that low to maybe mid-single digit type growth environment overall, and we wouldn't actually subscribe to that anytime soon. We're going to return to those, double digits or in some case 20% growth that we saw several years ago. As we move out of the automotive and into the industrial marketplace, I think this is the one, and again, I referenced it back when talking about the ERA data. This is a market that's seen the most notable supply, and you can see this from a top-down view of manufacturing here in the US. When you look back to that late 2025 period, and again, for those that have been on this chart or have seen me present this chart in the past, I would categorize it as, historically, we're in a low single digit, flat to up, which coincides with PMIs that hover right around 50 or below, indicating moderate growth, moderate contraction. But again, as you could see on the red line towards the end of last year, we've seen that trend ultimately break out, and growth rates now are, from a top-down standpoint, are again approaching that high single-digit range. So if you have an end market that's cooperating with high single-digit growth, and you have an end market where driven again by that AI kind of plus one, so grid, infrastructure, transmission, etc., HVAC, those types of markets. When you put that type of backdrop from manufacturing of high single-digit growth, then you add content expansion, electrification, the emergence of potential edge AI. This is ultimately changing a growth profile that I've historically categorized in that 6, 7, 8% range. I don't think it's out of the question to say the new growth rates going forward are more in that 8, 9% range. Certainly in every year, depending on the supply side dynamics, lead times, etc., growth rates can be above or below that. But again, I think the way to think about this is a CAGR that's shifting up a couple of points a year, which is certainly goodness for everybody within the ERA membership. Along with the industrial space, I do think it's important to talk about the defense here for a minute. And as you can see, similar but more pronounced with what we've seen in defense has been the breakout of year-over-year growth rates within the defense manufacturing market, which I would subscribe to as, the conflicts that we've had throughout Europe, throughout the Middle East, have strained. And again, I would tell you in conversations with various people in the supply chain, they have estimates on our missile supply. I'd be the first to tell you, I don't know if they're accurate or not, or the actual numbers. I kind of hope they wouldn't be, that they'd be able to figure out exactly the number of Patriot Tomahawks, et cetera, that we have. But if they're directionally correct, and we're talking about our finished missiles being roughly 50% depleted before these conflicts started, what that's ultimately created is a surge of orders across your defense contractors that's certainly being evidenced here again across the year-over-year growth rates. With that, I think it's important to note, if those are again directionally correct or representative of the actual end stockpile of our munitions and our high-value systems, more importantly than the growth rate approaching 30 years is the tail on this, right? I think we're looking and entering into an environment where defense spending, which again, I would historically deliver this, has been up and to the right. It depends on program, budget dollars, et cetera. And I think this year is certainly no different if you look at the headlines even of today, talking about the Pentagon looking to fund the conflict in Iran and everything else. But again, if you look at it over time, the electrification of our armed services is not going away. We certainly need to replenish our finished systems, and we need to prepare for the enemy of the future. So again, these are all tailwinds that I think are leading to a multi-year upcycle for those exposed to the defense side of the business. Switching over to the supply side, and again, I know I've covered a lot here and I'm going quickly, but I want to make sure that Mike has plenty of time at the end as well. Switching over to the supply side, I'll mix a bit of ERA data as well as our data, and I'll start first with the top-down view of the supply chain exiting the first quarter of the year. Officially, second quarter numbers start coming out tomorrow with Texas Instruments, and I think TE are the first two of the major suppliers out of the gate. But a couple of things to note here, again, from a days of inventory standpoint, up 16% quarter over quarter across the supply chain that we check, 4% year over year. To us, the days of inventory in the supply chain actually appear healthy and within line seasonal patterns, especially where you break down that sequential change where it was being built. It was being built in the comm supplier standpoint quarter over quarter. So those are suppliers like a Broadcom or a Marvell that are certainly right in the fold with the AI spend. It's being, the inventory was being built in the ODM and EMS channels. Again, those are certainly tied to the AI environment and building systems and holding inventory for deployments, and as well with the OEMs, with admittedly that does skew to the compute marketplace. So again, days of inventories look appropriate in our view. Switching to the dollar side of the equation, I think this is certainly a change, and I know I've referenced this before. This is certainly a change overall in a metric that we watch. Historically, I probably would have flagged a 30% increase or 56% in particular in the ODM EMS channel. But I think right now days certainly matters more. What we are seeing is, again, when you look to the ODM channel in particular, as they're building more of these AI rack and systems, they're carrying higher ASPs, which is driving ultimately the dollars of inventories higher. So again, I think it's more important to focus on the days. The days of inventory certainly appear healthy to us and within seasonal levels. I talked earlier when we talked about a brief preview on the supply side, again shifting gears here a bit to the ERA data and looking at lead times. Supply is certainly constrained across really all commodities. So the dotted line points to lead times overall, and then of course you could see it across the interconnect, the semi, and the passive space. Within the semis, which is the most notably stretched, approaching 30 weeks, as I touched on earlier, when you break down, some of that semis into a qualitative standpoint, memory is effectively on allocation. If you order new memory now and you wait for lead times, more often than not, you're getting quoted 2028. As I mentioned, the power semis in many cases are approaching 52-week plus. So while the word in power semis of allocation is not being used, for all practical purposes, we're on allocation for power semis. We're approaching 40 plus weeks across the discrete side. Really, the area that's on the low end would be the microcontroller space, where lead times for micros are by and large roughly in the 30-week range, but are certainly extending as well. When you drive down from that, as you can see, you've seen the passives jump a good deal here. Again, I think that's tied in particular to, most notably the tantalum and the tantalum polymer caps, but also we've seen it across the ceramic space with the higher capacitance ceramic MLCCs, starting to approach 30 plus weeks. But again, that's also stretching into resistors and other passives as well. And then again, interconnects, I would say extended, but much more reasonable. And ultimately, I think when we get to the growth, that's why their growth rates, while very, very robust, don't mirror exactly the level that we're seeing in the semi space in particular. With the lead times ultimately is driving some level of, or not some level, a good deal of inflation across the supply chain, and I don't think this should be a surprise to anybody on this call, led most notably by the semi space, which is also led most notably by the memory space, where prices in many cases are up 200% plus year over year. I don't have a section like I did in Austin for the memory outlook, but what I can tell you is it's really unchanged. With For those of you though that were in Austin, yeah, I gave the caveat there was a scenario where more capacity came on, which could lead to, some type of hope that extra bits flow into the market, et cetera, and all, which might correct. Yeah, I would tell you that scenario is off the table. So memory, expect more of the same for this year, maybe not the same rate of increases going into next year. The memory suppliers in particular have entered into long-term agreements. Some of those are extending out into the 2030 range. It's also noted from a pricing standpoint, a bulk of those, the pricing is relatively capped, so I don't think there's a ton of upside. It looks like most of the memory suppliers are looking to preserve margin on a potential downside with the long-term agreements that they're entering in the supply chain. So we know we have a capacity problem. We know pricing is going up. What are the suppliers doing to fix that? And again, I think, good news, bad news scenario here, however you look at it. One, there was a sharp acceleration in CapEx in 2025, looking backwards with, roughly call it 45% year over year growth off a low base in 2024. Inside of that, I do think the most important point to note is a bulk of that growth was driven in the memory space. So, while the numbers have shifted a bit, and for those that are interested in the numbers and what they are by category, please feel free to reach out. As I said back in Austin, capacity is coming, but capacity takes time as it relates to memory, which is the tightest and the most problematic. When you get outside of that, the spending in the foundry market has also remained robust, where last year's spending, I would say, in that analog and passive space was certainly much more muted. As we shift into this year, while the year over year has moderated into that low 20% range, again, we're at record CapEx levels from the companies that we track. So again, I think the story overall is that capacity is coming, in particular for the tightest of the tight, but again, a capacity takes time. So, as you roll this forward, what does it mean? And as I mentioned on the earlier some of the earlier supplies or slides, sorry, supply is the biggest governor to overall growth rate. So I think, from a rep standpoint in particular, new design activity still remains robust. That's still the key and heart and soul of being a rep. But ultimately, there's a POS component to that. And as lead times stretch, that certainly impacts the POS. While it's robust right now and bookings are robust, you do see pockets based on supplier lead time. You do. You all right there? Somebody have a question? Yeah, sorry. Um, you do have concerns overall on the availability and what impact to growth that has for a rep in particular. So I know I've covered a lot. What does this all mean? We'll start with what you guys all say. And as I touched upon earlier, growth rates or growth expectations for the year from the membership have gone up, going, each month in the year, starting at 7% and approaching 9% through the year. If you ask me to handicap that, I'd say they continue to end up higher than this as we progress through the surveys. So, I think near term it's being felt with across the membership. It is again worth noting concerns are growing and rightfully so, and I would subscribe most of those concerns to again that availability component. How do we see the market? And I'll start with the semiconductor one because as you can see, it's bordering nothing short on insanity right now. I think I referenced before, and those who were even on my April webinar, back in April, I was at 43%. I think the good folks at the WSTS were at like 12. as I referenced back then, the number is significantly higher. We're 90 days into the year. I can't quite get to a 90% number in particular when it's driven predominantly by price and price alone. Memory will be up 250%. So as you look forward to where we are now at the midpoint of the year, we're that magical bogey of $1 trillion. We have certainly blown through that. The market we expect to be north of 1.5 billion. Behind that, couple of things to note. One is memory. So when you think of memory, and I would tell you again, the pricing side of the memory is the biggest risk overall to this growth rate. Last year in 2025, the total industry was $795 billion. This year we have the memory market north of 810 billion. So memory right now, based on price by and large and price alone, is bigger than the total market was last year. Again, no change to this next year, just worth pointing out. So when you strip out your normalized memory, what does it mean for the rest of it? Again, I think we see, strong double digit again in semis for those broadline components like analog, like microcontrollers. We're looking at, growth rates well into that kind of 15% range for this year. So overall, still healthy, again, with the biggest governor being what can be built ultimately and delivered this year if you're a supplier, which drives this number, and then how much price they decide to take through the balance of the year. As you move to the interconnect, again, numbers, and I touched on this briefly earlier before, we've raised our interconnect numbers. Previously, we were at, call it 11 and 12%. Now we're, approaching, we're 18% approaching 20. Two things here. One, AI still has disproportionate impact to the interconnect space, as you've seen significant copper expansion with the data center, with the infrastructure for the AI data center. So that's certainly a tailwind that remains unchanged, both from a unit and content standpoint. But more importantly here, we're seeing that broadline recovery really across all end markets in the interconnect space, which is goodness. And again, as I referenced earlier, we've seen in some cases upwards of 5 price increases across the interconnect supply, certain interconnect suppliers this year. And again, as those get folded in, that's a continued tailwind. So interconnects in the high teens range, and as the year goes on, wouldn't be surprised if we continue to march that higher. Lastly, from a passive standpoint, we're at 15% here. I'd be the first to tell you, I think this is a forecast I'm the least comfortable with, meaning that I still think it's too low. Could easily make the case again with what's transpiring that it's 20% growth for the year. So with that, I know I've covered a lot. I'll do my last plea. Please, 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 please help. This is your data. It's very, very good data. It's very, very accurate data. And it is for you to use with your internal teams and your customers. So please, please, please participate. So with that, what questions do you have? I know I covered a lot. Claire, I promised that I would stay within 45 minutes.
You did awesome, Dennis. Thank you so much for getting all of that in. Any questions? We have a couple minutes here for questions for Dennis. So please get them in the chat or just open your mic. I do see a comment from Bruce in the chat. I think he typed this at the beginning. I'm seeing quite a bit of anti-data center backlash as well as build projects being canceled. Do you have any comments on this?
Yeah, Bruce, it's I would not disagree with you at all. The backlash, the backlash you see in the press and local communities, and I'm no expert in noise pollution or anything else, but the backlash is certainly there. I think by and large across the US, when we just have general conversations with people overall, there's a belief that even if you look at a geopolitical if you look at a geopolitical standpoint, there's national security, et cetera, but it ultimately falls to that not in my backyard. So there's a little bit of a NIMBY mentality with this that's creating the backlash. As it relates to the numbers, it has not had a material impact. And I could tell you the reason why. If you look 3 years ago, there were roughly 1,500 data centers in the US, and by the end of this decade, they're expected to be 3,000. So, you know, when you look at a doubling of the data centers over a 5 year, call it window, give or take, or maybe seven, you know, even if there is noise around it and it ends up being, half that growth rate due to the local political climate, et cetera, it's still a significant growth opportunity for the industry. But it's certainly something to watch close. That's something, I would tell you we have no edge on, in terms of what local populations think, but thus far, I would tell you the industry just keeps barreling ahead and building them.
Okay. Any other questions for Dennis? I don't see anything else in the chat. That might be it. And then as Dennis said, he will give those slides. I'll post the slides that he just went through along with his recording at the end. So thank you, Dennis, so much.
Thank you, Claire.
Uh-huh. Okay, I'm going to turn it over to Mike Budde Jr. Hello. Welcome. I'm just going to turn it over to you, Mike, and you can take it away on
Sure.
your topic.
Thank you.
Mhm.
Hello, everybody. Give me a second here. Has everybody seen my screen here, Claire, you think?
We can see it. Yep.
Yeah.
All right. Well, good afternoon. First of all, thank you to Claire and Ed and everybody at ERA for another opportunity to lend our voice and our eyes and mostly our ears to one of these live sessions. It's always a pleasure. And for those of you that don't know us, I'm going to just cover a very brief introduction to Budde Marketing, who we are, why we're relevant for ERA, and even provide a little bit of the numbers that kind of tie in. Not kind of, they really tie into Dennis's numbers here as well from the POS end and what we live in. So for those of you that don't know us, we're just located outside Chicago. We work with about 200 different manufacturer brands, and it says 1,500 distributors. That was our latest count. If you were to put a gun to my head and make me tell you how many distributors there are that we collect from, I'm just surprised there's still 1,500 reporting, but we're collecting on behalf of all these different distributors and manufacturers to try and normalize this data. We're processing a large chunk of POS inventory and direct sales data throughout the month at the time, and obviously throughout the year as well. Certainly not to the degree that I can dig into a lot of detail. This is obviously some proprietary information to our client base, but I will be able to offer a little bit of insight to the industry performance. And then I also wanted to touch on, those of you that are aware of us and aware of Orbweaver, a recent acquisition back in May. I'm joined by Chris Zazelka here as well from Orbweaver, who's able to chime in. And I don't want to present a lot of material, more so open the floor once I go through a few of these things, if there's questions or comments from the group, as many of you may be new to the acquisition news, but for those of you at EDS, I'm sure you saw it there as well. So what Budde Marketing does, and this is relevant for the context of some of the data analytics that I'm going to be able to provide you here, but essentially we collect all of the POS activity throughout the channel from distributors on behalf of our manufacturer clients. Much of that data is very non-standard. It's an overused terminology, but it very much applies to our core business, and that is siloed information coming from a number of different distributors. We essentially work as that middle warehouse that ties into between the distributor and the manufacturer, takes all the non-standard data, makes it useful so that we can track performance, we can pay commissions to the reps, we can track splits and ensure that all that data is accurate. We're currently working with ERA, ECIA, NEED, and NEMRA, and then from an integration standpoint, many of you reps on the call here working with RepFabric or Empowering Systems. I know they're one and the same, but essentially all that data gets piped into the rep systems as well, and we can do that via API to a number of different CRMs and basically keep the data flowing from the distributor all the way out to the rep and the sales teams. The other thing that I did touch on is the industry analytics. We put together a DTAM report. We've been doing so for many years. The good and bad of it is the bad is we're limited to the data that's backed by our customer base. So the more we grow and take on new business, the more that DTAM data gets a larger picture and larger snapshot of the industry. But it is limited to our client base. But it is landed sales and landed POS and true inventory in the channel as reported by the distributor. So it's an interesting kind of a different perspective, smaller chunk of the analytics that we looked at here with Dennis. This is a trend chart. It might be a little hard for you to see. If you look at, chunking this into thirds, essentially, and you go back about a third of the way is the beginning of 2024, and that starts to show the trend line. The red one is the inventory in the channel as reported by the distributors. The yellow or gold one is the direct sales data that we manage on behalf of the manufacturer. And then the real critical one is the light blue, which is the POS average index. So this shows kind of an interesting story. If you look at the trend all the way back to January of 2021, you can see where the inventory and the POS kind of decoupled and the inventory was inflated in the channel. POS started to slide in late 22 and all the way through pretty much like early 24. Then we had this correction gap that you see where the light blue and the red lines start to converge together. And then pretty much to Dennis's point that he brought up in one of the early slides, the inventory remains healthy as the sales in the channel, the POS, that light blue line continue to trend up. Pretty dramatic sales lift from our perspective in the POS data. And it could be a number of different things, but from our perspective, we used to crystal ball this stuff. And then I realized that, I don't do a very good job of that. I'm going to let the data talk for itself. So I'm just going to present it as it is, and you guys may be able to infer why this is happening. But from our end, there's certainly some ideas, and Dennis touched on many of them. The other area that we break into the industry analytics is our DTAM report. So this is broken down by ERA territory, and it shows these specific territories across North America. And these are also represented in the ERA hover map for those of you that have that. And a lot of this information is also shared for ERA members that are tracking when they put out, the monthly index reporting. But this DTAM specifically, I wouldn't, and I'd caution anybody to look at this as an actionable data set. This is really temperature checks on the industry or your territory. We gave a targeted presentation to a specific territory years ago, and essentially it was all bad news. And I'm like, well, again, this is limited to our data here, but it shows your territory is shrinking and it's smaller than you anticipated. In a lot of ways you can look at that and say, well, the New England territory is trending up, and I don't want to go to my New England rep and say, hey, how come you're not trending with the Budde DTAM? It's not that literal. It's more of a useful tool to see where are some of the movements in the channel relative to POS. And it's also what happens sometimes is a manufacturer client might reach out to me and say, I'm curious, we might be taking on a rep here in the Southwest. How large is that territory that you guys see it? And I can show some DTAM numbers that say, look, if you combine the Southwest region with maybe 3 or 4 of these territories, it makes up about 20% of the overall TAM. So certainly worthy of putting a rep in that area and really driving sales and getting a voice out there from the rep community. So the other thing I wanted to touch on, obviously, was the acquisition of Budde Marketing. So our company has been around. We're celebrating our 30th year in business this year. Actually, last month was our 30th year officially. And back in May, this is something that Chris, who again is on the call, we've been talking about the synergies and between our two companies, but also the lack of uniformity across the data space in our industry. And many of you on the call, I'm sure you could raise your hands and say you have probably 4 or 5 different areas you go to get your data today. Orbweaver providing certain information on the front end of the data life cycle, the product data syndication, the part information side of it. That's all happening on the early stage of the life cycle, and many of our clients using Orbweaver for many years before the acquisition, alongside using our systems. We all have different ways to look at this. Our dashboards, our how do we feed the ERP systems? What are the reps using in their CRMs? And the synergies between our two companies are really about eliminating the noise of multiple sources of truth in the industry. I think in short order, and I'll get to that shortly, but what we'll be able to accomplish with the merging of these two, industry, both of these companies are from this industry. Originally, they started the companies mostly functioning in our industry. I believe that we will be able to, source all this information into more of a centralized single source of truth. And that's really what my goal is with this whole acquisition, and some of the ways that we're going to be able to accomplish that. So obviously, I just mentioned in May, for those of you that were at EDS, Chris and the team were there as well. Made a bit of a splash with the marketing campaign in a good way, I think, in the sense of making everybody aware of that while we're at EDS, so that in case you see a member of either team in the halls, we can start to talk about it a little bit. Since then, it's been really a lot of integration. And again, show of hands, I'm sure there's plenty of folks on this call that have gone through a M&A activity. The early stages are just like, okay, look, we just parked our cars next to each other. We popped the hoods. We're going to look at both engines here and see what we're working with, and then see if there's something that either engine can benefit from. That we're in that stage today. But while we're doing that internally, I want to make it clear to the rep community, to the distributors that are listening in, the manufacturers, we are here to listen to what feedback you may have, as we always have done at Budde and certainly at Orbweaver. What are some of the inputs you have on what either or both companies need to work as we start to build towards the future? So we've already done that with a number of reps up to this point, and even talking with Ed and Walt, recently about some of the things the industry from the rep perspective is lacking a little. So we're going to be taking a lot of that feedback as we build the products towards the ultimate goal in building Signal, which is an Orbweaver product that's going to lay in the Orbweaver Data Hub platform. And essentially Signal is kind of if you've seen it's a reimagining of what we've been doing at Budde. Everything that happens at our company today at both locations has a reason for doing so. Budde Marketing over the years has been very specific for each one of our clients, and that's an important thing to take that feedback as we build Signal when we do this. But in reality, when you talk about point of sale exchange in our industry, it's way behind some of the other data exchange that companies like Orbweaver are doing, where we're API integrations between these we're pipelining this data back and forth between distributors and manufacturers seamlessly and automated. A little bit on the Budde side is a much more pragmatic or literal linear approach to how we're processing this information. So Orbweaver right away, and Chris certainly identified the opportunities that we have together, is let's take what's working very well for Budde and for the clients and see if we can't streamline that a little bit more. And the more we dug into that, going back on maybe a year or two ago, probably 2 or 3 years ago, the more we identified the synergies between the two companies. And that's where this Signal platform is coming from. And it's certainly taking a ton of feedback from the ERA, from the industry, and from our clients in order to get there. The main point from the Budde Marketing perspective, obviously nothing's changing in the sense of I had 2 client calls today, and the questions were, what's happening? What's going on? Well, honestly, until you want change, it's business as usual. The Budde platform, the team, everybody's still intact. I'm still here. It's really just breathing a little bit of developmental life into the current Budde company while we work together to build the future within the Signal and Data Hub platforms. So as you can read here, it's really developmental scale was what Orbweaver's bringing to the table here. From the Signal product standpoint, it's very much continues to be, as Budde always has been, a manufacturer-focused product. But the end users of that product today from Budde are the reps, and they'll continue to be that. that's an important piece to understand, I think, from the rep community. And we're already diving very heavily into, developing some feedback loops for the reps. So if those of you that are listening in, you want to be involved in some of that feedback, you have some questions or ideas about that product and how the reps would use it, I would certainly welcome that. If you don't have my information, I'm sure, it's part of the presentation as I send this out to ERA here, and we'd love your feedback. One last thing that I want to touch on, and I'm going to be very careful because I do have a short amount of time with the group here. I don't want to open up a can of worms with AI. I just want to talk about very briefly the practicality of AI and how it's used in our industry. What I envision in short order here, what we're building together as a team with Orbweaver, is a real practical use of AI relative to channel data. Today, if you just throw POS into an AI engine, I would be very careful with that. Number one, make sure it's a secure engine. And number two, you're probably, it's kind of like the old question of who's watching the watchman. Did the AI clean it properly? Because we're paying commissions on this. The long and short of the message is the AI does not perform well with bad data sets. And if you want to refer to a bad data set in the electronics industry, there's nothing worse than point of sale. When my dad started the company, he literally took the entrepreneurial advice of find something that is really dirty and messy, nobody likes to do it, and then just be very good at it. That's literally how our company started. 30 years later, POS is still pretty messy. We've done a good job together as an industry to work on that. I think the merger between Budde and Orbweaver is just going to continue to drive that to the next level here. But AI will play a critical role in that once the data is clean. And that's a important thing I wanted to touch on with the group, that speaking with some rep colleagues of yours, I don't know if they're on, but that was something that I thought important to include here. Okay, I have a little more on there, but before I just slide deck everybody to death here, wanted to open it up in case anybody had any questions or comments here about Budde, Orbweaver, the acquisition, anything.
You did it perfect, Mike.
There you go. No questions asked.
Nick, ask a question. You didn't hear me.
Okay. Any questions for Mike? All right.
Cool.
Thanks, Mike, for coming.
I appreciate you guys having us, and I certainly, always pay attention when Dennis can grab a microphone and have an audience. It's always very interesting. And now all my notes, I have to go back and do some work on it. But thanks for letting me share the stage with him and letting us share a little bit of the story of what's happening back here.
Yes. Awesome to hear from you. Thank you for being on. So thank you. If you're still on, thank you, Dennis. Thank you, Mike, for being here today with all of this information. We really appreciate it. The recording of this session will be posted on the ERA Live section of the website and our YouTube channel within 24 hours. The next ERA Live is TBD. It will probably be sometime in September, but don't have a concrete date for that yet. So please stay tuned to emails for information on that. And thanks everyone for attending. Have a great night.
Thank you, Claire.
Thanks. Take care.
Thank you.
Bye-bye.
Thank you, everyone.
Thank you all.